Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin with a big issue, positioning for the second half. Dawson of NewEdge Wealth saying this: the trend is still your friend, powerfully up. Don't fight the trend of positive equities, but be aware that the market could shift quickly if growth forecasts for EPS or GDP begin to get trimmed. Cameron joins us now for more. Cameron, good morning to you.
Good morning.
Are we starting to see that already? Are those growth estimates starting to be trimmed?
It happened Friday. For the first time in 12 months, we saw 2024 GDP estimates get revised lower. It's just slightly, and it's just one data point, so it's not quite a trend yet. But that is a big shift from the last 18 months, where we've had rising GDP forecasts pretty much every single month, which has provided a boost to equities, provided a boost to credit markets. That's why you can trade at such high valuations, such tight spreads, because you're raising forecasts. If that starts to change in a more meaningful way, that's when you could have a more risk-off move.
Growth has started to disappoint relative to expectations as well. That's been a theme with the incoming economic data. Can you walk us through what you're looking for in the data this week? Are you in the camp of Mike Darda, where you think that we're weak here and the Fed's got to respond, or David Kelly, where things are slowing but they're not slow and this is just normalization?
I think it is more of the normalization. We're not at the point yet where things are falling off a cliff that you say we're headed deep into a recession, but we're definitely coming off the boil. And if we think about the labor market, to your point earlier, you have two very different stories about the labor market. We think it's much more likely that it's somewhere in between, where the real jobs number is somewhere around 100,000. What that means, though, is more important for the unemployment rate, because we're already at the Fed's target for this year at 4.0%. If that continues to creep higher, and if you continue to see this moderation in the PCE, it does give the Fed the degrees of freedom to at least do one rate cut, maybe two rate cuts this year. But then the question is, what happens in 2025 if they start to ease policy, fiscal remains stimulative, and then we start thinking about the Republican sweep?
You say that it's important to just keep going with this momentum trade just simply because it is so powerful. And yet something that Torsten Slok put out there was the top 10 companies in the S&P 500 make up 35% of the market cap, but only 23% of earnings. We are basically pricing in a much more significant boost to earnings in some of the names that have been delivering, let's be honest. Does that concern you at all, that if we do get a reality check, it will be a painful one?
We are slowly shifting from a world where the stocks were going up because earnings estimates were getting revised so much higher for these big mega cap names. The market was just chasing the earnings estimates higher. Now we're at a point where it's really multiple expansion that's boosting names like Nvidia, like Amazon. And so the question is, how much can that sustain, mostly as the earnings growth rate for the Magnificent Seven decelerates significantly into 25. And even into the back half of this year, you're going from a peak of over 60% growth for Mag 7 names to about 15% by the time we get to the fourth quarter. And interestingly, the market has priced in that the rest of the 493 will have about the same amount of growth. The challenge with that, though, that's a really high bar for those 493 names to see mid-single digits or mid-teens kind of growth, which just means there's room for downside surprise in earnings.
Well, this is something that David Kostin of Goldman Sachs really picked up on, that basically that earnings bar is the highest going back to 2021. This all paints sort of a bearish picture, and yet you're still bullish. So how much do you sort of shift your position based on something that you see in the data or based on an earnings report versus just go with momentum because that's what's working?
Yeah, the trend, the momentum, and the liquidity has been so supportive. We think it really becomes more of a challenge into 25, where we do think 25 estimates are too high. If you unpack them, you have GDP or revenue starting to accelerate and 100 basis points of margin expansion. That's in a world where nominal GDP is going to decelerate. You typically don't get revenue acceleration and big margin expansion in a moderating nominal GDP kind of economy. So we think the $278 a share for 2025 is firmly too high, but it may not be yet that we're starting that revision down cycle.
There's a phrase you used, you said, and then it was followed by Republican wave.
Yeah.
Is it too early to start considering that right now?
Based on the polls, no. And I think the interesting thing is comparing the starting point of a potential Trump presidency today versus 2016. In 2016, the unemployment rate was 4.7%. Wage growth was growing in the mid-2s. That's different than today. Wage growth is growing at 4%. So if you do something that constricts labor supply, what is the risk that you see a more pernicious kind of wage inflation cycle if you lose that bottom tier of workers that are coming in that have helped keep wages in check? I think you can do a similar thing on tariffs where you had deep deflation of durable goods at the start of his presidency. Durable goods inflation went from negative 2.5% to about flat. So how much could you see tariffs and immigration contribute to this inflation outlook?
So am I selling bonds?
I think that the risk is that yields do move higher, because the other thing we heard from the debate is that neither party is considering austerity whatsoever. So get used to higher Treasury issuance in order to fund the deficits.
So you basically agree with what Krishna Mamani was saying, that Thursday night on some levels was a game changer in terms of your market views and the increasing certainty around a potential outcome in November?
I think that the best output for this economy would be gridlock, meaning that they can't do too much. Don't change it. If it's not broke, don't fix it. The challenge is based on Thursday night, does that raise the odds of a Republican sweep where you could see more sweeping policies? You could see the full extent of the effort of policies actually be enacted. And I think that would be the risk for the market, is that you do get this inflation, you do get higher deficit spending, and to point out the tax cuts that you would potentially get going into a second round of a Trump presidency are not nearly as big as what we got in 2017, meaning we had those tax cuts to offset these other things. You're talking about 1 to 2% lower in the corporate tax rate, so you don't get nearly as much sugar as you get with the spinach of things like tariffs and immigration.
We're hearing this repeatedly throughout this morning. Cameron Dawson there of NewEdge Wealth. JPMorgan's David Kelly writing this: neither consumers nor investors are behaving as if they are scared. Investors have pushed the S&P 500 to an all-time record high 33 times already this year, while consumers have maintained a personal savings rate of 3.6%. David is with us around the table. David, good morning to you.
Morning.
A lot of people coming on the programme talking up a consumer slowdown, cracks in the labour market. Why shouldn't we be fearful of that?
I don't think we should be fearful right now. What we're seeing is a small downshift in growth. We have a problem at lower and middle income consumers. And if you look at consumer non-durable spending, things like food and clothing, just the basics, that was actually lower in May than it was in December. So we can see that slow down. But at the same time, we've seen tremendous wealth gains. And we've also seen tremendous wealth gains. We've seen a lot of payroll job growth, a lot of wage income growth. So as I look at the consumer spending will grow more slowly, somewhere in the 1.5% range going forward for the rest of this year, as opposed to 2% plus. But that's still enough. And so I think all that's happening here is the economy slowing down to, a little under 2 in terms of growth, a little over 2 in terms of inflation, but it's still pretty good.
So slowing, not slow. Can you tell me the difference between normalisation and something more sinister? What would that look like? What would change your mind ultimately?
Well, this is a very stable sort of. It's kind of like this very stable machine that sort of just pumps out 2s in terms of growth and inflation. Well, what could change that is something will change it. A, a shock, or B, a big policy change. I mean, we're just talking about. I do think that what happened on Thursday meaningfully increases the likelihood of a Republican sweep in November. If Joe Biden is the candidate, it's quite possible a lot of independents will stay at home, and so Republicans will sweep. Now, if they sweep, if you take Donald Trump at his word, you've got much higher tariffs. And now tariffs are a elixir for stagflation. Tariffs slow growth and push up inflation at the same time. If you took him at his word on immigration, the economy come to a halt because of deportation of unregistered immigrants or illegal immigrants. So, but I'm not sure if we can take him at his word. I think history suggests that perhaps it would be optimistic, or not optimistic, but it would be foolish to take him at his word in this stuff. But still, something to think about. I mean, some policy shock could absolutely tip this economy into recession.
Hold on a second. John said that basically Friday was the first day of this election cycle, at least for markets. How much do you actually rearrange what you think about how to position markets as a response to this idea that you think that there is a greater likelihood of a Republican sweep?
It does make a difference. I mean, let me give you one example. The 2017 tax cuts. If Joe Biden is reelected, then some of those tax cuts will be extended beyond 25, but not all of them. If Donald Trump is elected, I expect that whole thing to go through. And if you add that to what the CBO is already looking at in terms of the growth in the debt as a share of GDP by the early 2030s is going to be about 135% as opposed to 122%. So you're going to have significantly more debt if we extend all these tax cuts, and that means a higher level of long-term interest rates.
So in other words, are you more bearish on long-term bonds right now than you were, say, Thursday morning?
Yes, I think it would be a rational thing to be that way, yes.
Let's build on that a little bit more. If that's how you've responded to Thursday night, how should Chairman Powell respond to this? Because surely he has to factor this into the equations for monetary policy looking out 12 months and beyond.
No, I think that to be honest, I think that's too cute. I think he should make policy for the economy that he's got, because I think we can change our views a little bit here, but he always sort of takes monetary policy as given. Right now, markets are pricing in about a 70% shot of a rate cut in September, and I think that still makes sense, because what I'm saying earlier on about a downshift in growth is real. That's what we've got right now. What happens after the election does depend on how policies are implemented, but he can't really make policy based on how the election might turn out and then what a particular configuration in Washington might mean for policy. It's just too far down the road.
Can we think back to 2017 when we got those tax cuts from the Trump presidency at the time, how the chairman of the Federal Reserve at that point, how the Federal Reserve adapted, given they had to wait for the policy, they had to wait for it to be delivered, and they had to wait and see what ultimately it would do to the economy?
Well, they were also getting a lot of incoming from the administration, which is very unusual. But the administration was trying to bully them into easy monetary policy, and we did actually end up in 2019 with very easy monetary policy, given an economy in which inflation was actually beginning to build. So, I mean, I think there's a real question again. If Donald Trump is elected and he has a Republican Senate, does he simply does he want to replace Chairman Powell? And it's I'm not a psychologist here. It's a real question of what the priorities would be for Donald Trump if he found himself in the White House again.
There's another question on top of all of this, which is just how much leverage the next president's going to have with respect to pushing different levers, given the economic fragilities that we started this conversation talking about. We began by talking about the second quarter and whether the idea of the underperformance of the equal weight, the underperformance of the Russell 2000 was a sign, almost a canary in the coal mine, of some kind of weakness under the hood that is pervasive and that really is on a tipping point. Do you believe that to be the case? What would you have to see this week in the data coming out to give you that kind of sense?
No, I don't think so. I mean, I don't expect to see very rational signals coming out of the markets, to be honest. I mean, to me, when I look at the concentration in the US equity market, it speaks to the euphoria at the top, not rational thought at the bottom. I mean, I think that's what's going on. And if you look at the US share of global equity markets, the same thing. The US should not be 65% of global stock market cap. So when I see these things in markets, it doesn't tell me that markets are rationally discounting an oncoming economic slowdown. What it tells me is that people are simply doubling down on existing bets because they think this party's going to keep going.
Just to sort of put this all together, do you believe that some people are investing in big tech simply because they have all of this uncertainty, including the election coming down the pike, including the sort of uncertainty around the economy, that the one haven has been these tech names that keeps delivering, and that if we get certainty, that could actually encourage people to leave those names and go elsewhere?
Well, we were talking earlier on about our granddaughter, and we took her out to the park recently to blow, and she was blowing bubbles for the first time, but it didn't work very well because it was really windy and all the bubbles were bursting. But if you had a really calm day, bubbles grow great. And the problem is we've got a really calm economy that just grows bubbles. What's happening is people look at the economy and say, that's fine. And then they double down on the bet on mega cap tech. They double down on the bet on the US. None of these bets are going to get reversed until something shocks the system. And right now, the economic climate is just too calm.
We'll see if November provides that shock. David Kelly, it's good to see you. Thank you, sir. David Kelly of JPMorgan. Michael Darda of Roth MKM writing this: the hallmark of good central banking is to try to be forward-looking so that the slippage between the neutral rate and the policy rate is kept to a minimum. Reacting belatedly is nothing more than a setup for a rinse and repeat, boom to bust set of cycles. Michael joins us now for more. Michael, wonderful to catch up with you, buddy. You're one of the very best working out where we are in these cycles. Can you tell me what's flashing red on your dashboard right now? What is it?
Thank you guys for having me on. I appreciate it. Well, look, I actually just took a look at the Bloomberg Surprise Index, so I'll give you guys that prop. It's rolling over, right? We've had a raft of pretty weak data. We're going to get some additional manufacturing figures this morning, but housing's been rolling over. We're starting to see some upward pressure on jobless claims. First-time claims still look pretty healthy, but continuing claims are actually about 35% off the lows of the cycle. And despite pretty strong headline payroll growth, the unemployment rate is moving up. It hasn't jumped drastically, but we're 0.6 off the lows. And if you go back historically, it's very unlikely that you see something like that without the beginning of a recession not far off, or actually, in it, and you don't realize it. And so I agree with the quote from Mohammed that you played earlier. I think that the risk here is because the Fed is dealing with the aftermath of this 2-year inflation overshoot, once bitten, twice shy. Most likely, I think they're going to be a bit late and a bit behind the curve here.
Michael, when clients say we're just normalizing, that's all this is. We're just normalizing. It's nothing worse than that. How do you counter that point?
Yeah, well, I think it really, normal depends on the state of the business cycle. And so the first mistake the Fed made, I think, was a bit of a primacy recency bias. So the previous cycle was very low inflation, very low growth, in a long period of very low rates. And so the Fed really acted aggressively. Fiscal policy was much more aggressive, and no one wanted to believe that we were in a V-shaped recovery with high inflation. So it took a while for the Fed to acknowledge that, and they were way behind the curve. And so normalizing meant raising rates much more and then holding them higher. And now things are decelerating. We haven't totally fallen off a cliff just yet. But if the cycle continues to weaken and the Fed is just standing pat, then you have essentially a passive tightening in monetary conditions. And that's the end of the cycle. So business cycles don't last forever. And the reason for that is it's very difficult for the Fed to be precise in tracking the neutral interest rate. And Powell talked about this in the last press conference. So normal is very much a relative term. It depends on the state of the business cycle. So, 5.25% to 5.5% policy rates, a year ago may have been appropriate. But, moving into the fall, that might be, much too high for the state of the labor market.
Given all of that, and given the data that we have coming out this week, what's the most important that you're looking at to really gauge how urgent the Fed should feel about cutting rates?
Yeah, I think the labor market data on Friday should be interesting, and whether we end up seeing this divergence between the two labor market surveys being resolved, anytime soon. So the unemployment rate comes from a separate survey of households. It's generally viewed as not as reliable, but it does tend to move at turning points. And the unemployment rate itself is really only revised once. So as a singular summary statistic, I think it's a super robust, coincident to slightly lagging indicator, and, can at least confirm what's happening to the business cycle. Are you growing at trend, above trend, below trend? If the unemployment rate is inching higher, that's a very strong signal that the economy potentially is, if it is growing below the growth rate of potential. And so, that should potentially be setting off some alarm bells at the Federal Reserve. And, they are watching it, but, other data has looked more robust. So there's a debate going on.
Mike, what's the signal for markets right now? We talk about the divergence between the benchmark index level, the S&P, up almost 4% in the second quarter, even though equal weight was down about 3%. Is this a feature of the market strength or a bug of that market strength?
Well, I think it's both. It's a feature of the AI frenzy. So the S&P 500 has had just tremendous gains, and those have been driven essentially by 6 or 7 stocks in 2 sectors. On a year-to-date basis, the small caps are sucking wind, transports are weak, and so those areas might tell us more about the state of the U.S. business cycle than what's happening with the S&P 500, which is so AI driven at the moment. And so it is an interesting divergence. I mean, the transports have been underperforming the S&P 500 in a way that you see at the end of business cycles. And so that's definitely something to keep an eye on. If we can think in a multi-year, over a multi-year horizon, few can do that. But, I think some of these areas that have lagged, in particular the small caps, I do think if we're thinking in a 5 or a 10-year framework, I think there's more upside there than maybe some of the areas that have performed so well. And I'm not saying, step out there and start shorting tech stocks today. I mean, anyone who's tried to do that has been totally run over. So, a frenzy, the old quote is they go much further than you think, but they don't correct by going sideways. So, dangerous game there. But I think if we're thinking longer term, we probably have to pull in the expectations for the S&P 500 and then maybe be a bit more optimistic about some of the areas that have lagged.
I was going to say that's what we call a trade for the brave. Michael Darda of Roth MKM.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.